Hey guys, what's up? In today's episode, I wanted to go over how anyone can make 30% from a bear market crash. I'm going to talk you through very simple step-by-step strategy on how you can protect your money during a crash and also turn around and make some money in the process. Guys, remember the market is a zero-sum game. So for everyone who loses money, there's someone who is making money. And I can teach you how to be the one who makes money during these crashes. All right, guys, so let's just dive into the charts right now and I'll give you my step-by-step system. All right, guys, so first things that you need to understand is the different trends of the market. The market can only be in three trends at one time, or three trends at any time. The first trend that it can be in is an uptrend, which is when it's going higher. So when the highs are getting higher and the lows are also getting higher, that is an uptrend. You can also be neutral when it's just staying range bound, where we're just going up and down, up and down, up and down. That tends to happen in this gray area. And then we can also be in a downtrend, which is known as a bear market, where the lows are getting lower and the highs are getting lower as well. So this would be an example of a bear market. This would be an example of an uptrend, and then we have some neutrality right here. So again, once we identify the markets, then we can know where the best place to enter is, right? We want to enter when the market starts to enter a bear trend territory. What we'll do is we'll sell the stocks we currently own, and then we'll buy the stocks that I'm about to suggest. All right, so this is the S&P 500, and I wanted to give you this because this shows us when the overall market is headed toward a bear market or towards a crash. All right, guys, I know these lines may look weird or confusing. It's basically just a trending band indicator, which is something that I made to help people see the different trends in the market. But regardless of if you have this or not, you can use the 200-day moving average. And so you come up here to your indicators and you type in moving average, and then from moving average you can actually put in the 200-day period. So you can see by default it's probably like 9. Yeah, you can change this to 200, and then you'll get to the 200-day moving average. Now I'm going to delete that because that's what this gray line is right here. It's the 200-day moving average. When the S&P 500 gets below it, we have a really high chance of the market crashing. And so you can see here when it got below it, we start to see that crash down to the downside. Okay, so now that we can identify trends in the market, when we should go short and other things like that, what stocks should we be buying to make money on the way down? All right, so you may have heard of things like metal, gold, silver, etc. All those are great, but I want to mention some other ones as well. A great example is the VIX. VIX is the volatility index. So again, there are a bunch of different ETFs that are based off the VIX. But again, what happens is as you can see here, when the market dropped and we had that bear market phase in the S&P 500, VIX actually shot up. You can see it shot up about 260%. So again, you can get an ETF version of VIX when the S&P 500 drops, or when it has a great sign of it going down. You can slowly start to invest in VIX or other ETF similarities, and you can actually get in and make a huge gain that way. So again, that is one option, but my favorite way is to use inverse ETFs. SCS is a great way of that. So what these inverse ETFs are is they do the exact opposite of what SPY does. Remember the first stock chart that I showed you, how it's just going up over time, and then it had that one crash where it tracks the overall market? Well, this one tracks that exact stock, but in reverse. So when the stock goes up, the stock goes down. When the S&P 500 goes down, the stock goes up. And SCS is a leveraged form of that. So as you can see here, when the stock, when the S&P 500 went below the 200-day moving average, it shot down, right? Well, on the STS, which is the inverse, when it got above the 200-day moving average, it actually shot up. You can see here that it shot up roughly 50%. And so guys, what we're seeing here is on average what I've been able to teach my students who did this back in 2018, who also did this back in March 2020, is they're able to make around 30% just by selling out of their longs, which means they get out of stocks that they're holding and then they move into, whether they're only putting 50% of their portfolio or something like that, into inverse ETFs, they can make some great money. So guys, this is a way that anybody can use to make money when the stock market is about to crash or crashing. And so what are your options for this? Okay, one is the option that I take and that I teach people around me to take, is that you sell the stocks that you're currently holding because they're about to drop. You put about 50% or so into an inverse ETF or VIX. You make money until it hits this top yellow line, then you take profit. So again, in this instance, it would have been here to here, and you would have made about 40% in 13 days. And then from there, you wait for it to bottom out, and then we'll find the bottom on the S&P 500. We'll buy in, and then we'll trade it back down to back up to the upside. And so again, that's one way. Another way is to sell your weakest stock. So for instance, let's say you're a long-term investor, but you want to hedge your downside, or you're afraid of it going down and just destroying your returns. Well, sell your weakest stock. Sell 25% of your weakest stock. Let's say your weakest stock is, I don't know, I'm making up a stock, AMD. Let's say AMD is your weakest stock. It hasn't been performing well. You're afraid it won't perform well if the market crashes. So you're going to sell out of that stock, use those returns, invest in an inverse ETF, invest in VIX, invest in gold maybe, and then you have a way to little offset your losses so that when the rest of your portfolio does crash with the market, at least you'll have something offsetting it and give you some profits. And that's a way to hedge or to offset your losses. So again, guys, make sure that you're using inverse ETFs. We have SQQQ, you have SDS, which is my favorite, you have VIX or UVXY, which is the ETF version of it, and it's just a great way to hedge or make money to the downside. Remember, anyone can make money during a bear market. That's where millionaires are made. You just need to have a plan and make sure you're ready for that plan. And so guys, that is the game plan for bear markets. Watch for the market to have a sign to push down. Once it gets below the 200-day moving average, or if you have the 20-band indicator below the red line, we know we are entering a bear market. We can short or we can buy inverse ETFs, and then once it crosses back below this bottom yellow line, we know that the market has officially dipped and is starting to go back up. We can buy stocks and make our way back up. All right, guys, remember that a bear market can only crush you if you're not prepared. So thank you so much for watching this video. I have so many other things coming out over swing trading and investing in options. So if you're curious about anything on how to master the stock market, please smash that subscribe button, and I will see you in the next video. Also, if you want this trending band indicator on TradingView, click the first link below. All right, guys, see you in the next video.